Well, welcome to Building Wealthy Habits. We are talking about risk today. That's, I think, going to be a great conversation. There's a lot of risk. We tell a lot of clients lately, there's a lot of yellow flags out there, and we're going to talk through what do you do with the risks. If you see a risk, do you just pull back? Do you make massive changes? How do we emotionally and take action to deal with risk in appropriate ways? So we have 4 or 5 risks we'll kind of talk through, but we're going to walk through what do you do with risk.
Yeah, and I think the biggest issue is that fear of loss is greater than anticipation of gain. And people's emotions grab them and they anticipate the loss. And I equate that to elevation. In other words, when you're first starting out, you're really close to ground level. But over time, your assets grow. And so you sense that you're higher. And so you get this feeling of falling. Again, hypothetically, you get this feeling of falling, and it really does paralyze people. They're thinking, well, it can't continue to go up. And I don't want it to go down. I don't want to go back down to the bottom. So they have a tendency to be paralyzed. And that's really a big issue, is that paralysis has a tendency to freeze people. And anyway, I think it's a natural reaction. There's nothing wrong with it, but it's also something you have to take control of.
Yep. But a lot of the clients that we work with are not, their very first investment, their very first, step forward where they're taking high risk. A lot of them, they've made their investments. They're moving towards retirement. They're moving towards selling a business. And, this is a nest egg that they have that they want to protect. And so we'll walk through a few of these. We got a few that they're top of mind. The first one I'll just talk about is the risk of valuations. Concentration. There's a bubble. Things they're so expensive. We just hit all-time highs, the last few weeks.
Yeah, and you can't listen to anybody without them talking about, oh, the market's going to fall. It's going to correct down. And my question is, well, corrections are normal. You don't go through a season if you're a farmer where there's not some kind of correction after you harvest. Well, you're not continually producing a crop. So it's the same. It's a natural process, is what I'm saying. Anyway,
yeah,
go ahead.
Yeah. And I think there's a level of, when we think about this stress, first acknowledging, there's a yellow flag here, right? There's a concern, there's a risk. And then I think we jump into this, people get into this kind of binary thinking of like, it's either going up or I'm losing everything. And to really review that a little bit and say, well, what if some of these magnificent 7 stocks are overvalued and they deflate? What if, and we walk through all those issues, and for us, we want to stress test the plan and stress test their portfolio. And we have a lot of clients who have the kind of emotional scars from 2000 or 2008 when they saw markets tumble. On the flip side, they've recovered, right? They've got through that. And not that we just want to endure pain, but we want to say, realistically, what would happen? And do we want to make some adjustments to the portfolio? If we have a couple of clients who have some, kind of side accounts that they're holding NVIDIA, Amazon, and, Tesla, two or three stocks in large quantities, that portfolio is at risk. But when we look at someone's, usually their retirement accounts or their larger accounts that we're managing, we say, what if, some of these stocks fall? Well, things will go down, but not in a way that is, zero thinking. It's either 100% or it's zero. No, it could dip, but it's going to recover and have a life to it. So that's a big piece.
I think the comment that Warren Buffett, somebody asked Warren Buffett about this, and he said the market's going to correct and it's going to be really bad. And Warren Buffett just paused. And he says, do you mean they're going to stop making Snickers? And the guy went, well, no, I don't think so. He said, oh, for a second, I was really starting to get worried. Basically, his comment was, life still goes on. Even after 2000 or 2008, life still went. So what's going on? And again, I come back to it. The natural, the biggest issue that I look at is debt. And the amount of debt that companies hold. Now, people could point to the government. We have a large amount of debt, and I don't want to take this venue to talk about how that's going to be dealt with and what the current administration is dealing with that. But I don't like debt. I don't like debt personally, and I don't like debt on a corporate level. You got to have free cash flow. You got to have plenty of reserves. Some of the wealthiest individuals historically always kept a cash reserve. And the cash reserve was equal to the amount of money they borrowed. They leveraged it, right? So again, it really depends on how you manage your assets and what's going on with companies. And that's what we do, is we really select companies based upon their sustainability long-term. So anyway.
Yeah, that's a great comment. So that's about the risk we have, and I think, like I said at the beginning, like it's okay to acknowledge these risks. Like we don't have to,
Hmm.
paint this Pollyanna picture out there. Like
Right.
there is risk. It's just how do we want to be responsible in the midst of this risk? So the second one we talk about a lot, and we've been hearing lately, is the geopolitical risk.
Hmm.
So it used to be earlier this year we talked a lot about China, we talked a lot about Russia. As of a few weeks ago, we're talking about Venezuela. We're talking about all these different countries, and again, like those exist. Those are real risks. The other part that is interesting is then how do we respond to that? Like geopolitical. You think back. I mean, Randy, you lived through the Cold War, seasons. You lived through when we were invading Kuwait or Iraq and protecting Kuwait. All different things that we've done, and how markets respond to that. Of course, they do. However, the markets continue, and kind of taking the responsibility. What's an appropriate approach in the midst of uncertainty out there?
And war is a really stark headline. I can remember when Egypt and Israel, they had the 7 Day War, and people thought, oh my goodness, the world's coming to an end. And the war ended so quickly, and of course things went back to normal.
Mm,
We can go back over the last 100 years and look at events. The Suez Canal was you know Egypt says, well, you're not going to come through anymore, and they blocked it. And there was just a lot of tension around the world. Now that was even before my time, but World War II, World War I. I mean, all these are very, very dramatic. I mean, millions, tens of millions of people were killed. At
mm,
the end of the day, do you trust your investments to sustain that kind of shock? Again, I keep coming back to it. The diversification, we talked about it earlier. The broader the diversification, the economy continues to move. So
yeah,
even in the events of stark reality, in the sense that you've got war and that kind of tension, the economy is too diverse and too broad. It's not going to just stop and fall to zero. The biggest threat we have is communism. I mean, it's a change of government. And a
mm,
change of government, they nationalize all the industry. Well, I don't see that as a risk in the United States. Hence, that's why we're the safe haven that we are.
yeah. People coming to. That's a great comment, and I think one of the things that we talk about too is it's adjusting and right sizing your investment structures for the risk, not timing. And I think especially when you talk about geopolitical, people think about, oh, what's the timing? I need to get in the market, I need to get out of the market, or
No,
even when we just talk about valuations, I want to be ahead of the fall or ahead of the bubble. But really, what we see is it's not about timing because timing's like you said, it's one, it's difficult, but two, the recovery can be much faster than you even think. So it's more about you know is my portfolio set well to go through some of these different
right?
structures? And you think about real estate in the United States in the midst of say World War II, as it went through, like I'm sure it changed, it went up and down, but people who owned apartment complexes, who owned homes before the war and then after the war, like those assets carried through, right? They continued as assets that were available. And I think that's the idea is we want you to be well diversified. We want clients to be well diversified so they can live through, some of these shocks that we don't know. I mean, no one knows geopolitically what's going to happen in the next year. Um,
No, nobody can predict when the market is too high, too low, the right time. I mean, to time the market, I mean, I've spent decades reading and trying to understand how best to balance a portfolio at various points. And my conclusion is that nobody knows for sure. You can get a sense, but nobody can time the market, and events can occur which will, if you sold and now your assets, you're sitting in cash, you have to pay taxes on your capital gains, and the market recovers and goes back up, and you miss the
yeah.
upcycle. It is so devastating to clients' portfolios to be out of that cycle, right?
Yeah. Well, even just a very recent example that people will remember is when Trump was inaugurated in February of 2025,
Right.
began talking about tariffs, the markets came down pretty meaningfully all the way till April. And I'm sure there are people who exited. I'm sure there are people who said that the world is doomed. We're going to time this. We'll get back in the market later. Well, April 9th or 10th or so, the markets turned around and were fairly robust for the rest of 2025. And
Yeah,
many portfolios.
it's been a V recovery, right? It has not been a U recovery.
Yeah, a slow U versus a really fast V that came back up, and yeah, that fast V has been a great recovery. So people who may have jumped out, may have missed out on some of that growth. So that's a big one. So I like that comment. We can't time it, but we want to manage through it. And for anybody, I think it's a good moment to see what's going on in the world. Is what I'm owning still the best stuff to own? And that's a better question than should I just jump out of the market, right?
Right.
To say, do I need to rebalance or make sure that I'm holding assets I really believe in? I think you mentioned Warren Buffett earlier. I think he is one of the main lighthouses, I think, to say, like, own things that you are excited about. Own
Right.
things that you think are solid businesses. And when they would buy them, he would buy them and hold them for decades, not because he's looking for a quick profit, but because he understood, like, this is a quality company. I plan to be here for the future, for the foreseeable future.
Yeah, I mean, he would buy what I call good companies. And as we look through our clients' portfolios, we go through it and we look at, are these good companies? And we
Mm,
don't bet the farm on one or two. We spread the diversification out amongst in some cases 30, 40, 50 companies. And then in addition to that, we look at your age. What is your need for growth? And again, goes back to that target rate of return that we always deal with our clients. How much do you need to make?
yeah.
And they're concerned about. I mean, we have a lot of clients who could make zero and they would be fine. But at the same point in time, we're not going to just stick their money in a bucket and bury it in the backyard. That's not what we want to do. But you want to look at your risk analogy based upon your age. And if you're 75 years of age and you've got several $1,000,000 in retirement monies or investments, what is your rate of return on that money have to be in order for you to end well and
Yep.
to
To be successful.
pay for all the expenses that you may anticipate going forward?
Yep.
I think that's just logic, but people lose their sense of logic and their emotions get ahead of them. And I can almost tell you who they're listening to on television when they open their mouth. You
Hmm.
know, they start talking about like this particular asset or this particular strategy or whatever. I'm going, uh-huh,
Hmm.
uh-huh.
I know who's
So,
talking their ear. Yeah. Well, and it's hard. We discuss ourselves, but also with others, is trying to get kind of unjaded information. And it's becoming, I think, more and more difficult because everyone has a bent. And you think of headlines or news stories, they need to be sensational in order to get clicks and eyeballs and
right.
people watching them. And so with that, you have a lot of these sensational articles, and often when you dig into it and realize what actually happened, yeah, it's a concerning event or it's a whatever it may be, but the way that it's sold or spun or presented is so, in my mind, sensationalized. It makes it hard to really get to the truth. So the next one, we'll move on a little bit. So we talked about valuation risk. We talked about geopolitical risk. The other one that the I think is becoming coming down. We're hearing it less, but it's still one that I hear on a regular basis is inflation. This last year in 2025, people talked a lot about inflation. Is inflation ever going to come down? I mean, eggs, fuel, all of these, housing, all of that stuff has been a big topic of conversation. But I'm starting to hear less and less of that as a going forward concern. But
Hmm.
that might come roaring back, in a few weeks from now. But the fear for a lot of people is the fear of eroding their purchasing power. They're concerned that in the future they won't be able to do um, what they can do currently.
Yeah, their dollar, their income, their wages, whatever it is going to buy less, and they're going to be um, really struggling by the time of each month and or by the end of the year and such as that. And again, I don't want to minimize that when you are trying to balance a budget and you come up short on that because your grocery bill is $100 more a month or $200 more a month. I looked at the utility costs in California, and we are
Mm,
at the highest of any place in the United States. And why are we that high? But at the same point in time, you can explain it, but it still has an impact on you. If your utility bill is, $200 one month and then a year later it's $400, well, that has an impact upon your lifestyle. And
yeah,
again, we can talk about all the reasons why California is higher than, let's say, North Dakota or wherever. But at the same point in time, budget analysis is important, and how you spend your money is important. I think a lot of people have a tendency to buy, just go to the store and buy retail. There's a lot of other ways to balance your budget and still be able to accommodate and live well. Live well. We have
yeah,
abundance in our country, but sometimes it's a pride issue, right?
yeah.
It's just how you do it.
Yeah, well, I think a big piece too that we start with is whether this is a concern that someone is actively concerned about their budget and their
Right.
expenses, that they're not being able to put two ends together, Or is this really just a concern for the concept of inflation? As you said, to go through the budget to say, if your electrical bill and your food bills go up, is that actually going to be a problem for you? And
Right.
often clients will say, well, no, but I think about my grandkids, or I think, and yeah, those are valid concerns, but
Sure.
it doesn't mean you need to change at times, it doesn't mean you need to change your investments just because it's this philosophical concern, even though the reality is they're fine with it. I think the other item is not to chase inflation solutions. We've had a number of clients who come up with, I see this with tax and inflation, but they come up with these clever tax strategies they heard from somebody, or these clever inflation solutions. Hey, this is going to hedge. This is going to, this is really going to fix it. And as we dive into what that vehicle or what that investment really is, it might protect about that one thing, but it really is going to be a drain on the rest of the portfolio meaningfully. And we've had clients, I mean, Randy, I'm sure you have lots of stories of these, that go into these tax hedges, and into the day, yeah, they had a loss, but they lost their money. Like, it didn't, they had a tax loss and it
I
accomplished that, but the investment was pitiful.
Again, I don't want to discuss my personal what happened in the 80s, but the 80s, the 1986 Tax Reform Act
Mm,
was devastating to people. And that was under Reagan's watch. He was the president at that point in time, supposedly lower taxes and, let it ride. But that law devastated people. They caught so many people off guard because the real estate they were holding, the investment structure that they were in, they were getting certain tax benefits. And then all of a sudden, overnight, it ended. And
mm,
you talk about, don't forget about the earlier recessions or later recessions. That was probably the one impact that had phenomenal negative effect. And there's no way you could prepare for it other than you don't trust the government. The
mm.
government will change on you. They'll flip. And when they flip, you better be on the right side of that flip or else you're going to get hammered. And again, I have a very cynical view of politicians telling me what they're going to do for me. They can change their policy procedures and policies that they lay out on us, and tax policy has changed. If you go back and look at the history of tax, I always love this. I always love this conversation with clients. Is well, they're complaining about taxes, right? And we're kind of talking about tax write-offs and stuff. So, what was the taxes in 1960? What was the highest income tax bracket in 1960? And they look at me going, "Well, I don't know. Was it like 40%, 50%?" I said, "No, it was 95%." And they almost fall out of their chair. So then I can go on and Google that and bring up the tax brackets and just show how bad it was from a tax standpoint and how repressive that was to growing an economy. And
Mm.
anyway, it's just very interesting what people remember or know and put it in today's scenarios, right? So
Right.
anyway,
Right. And the actions that people are willing to take to avoid some of these, tax risks or inflation risks. So I think there's just a grain of salt with any of that, that
right.
inflation, is a real risk. But is it, one, is it going to impact them? And two, what's the appropriate structure to deal with that without getting down these paths of these odd structures? So the next risk that we hear and we see is, we talk about the dollar in the US or in the national, international economy, the risk of de-dollarization or
Is the
currency
dollar
risk.
using its dominance? Is it gonna lose its reserve currency
Right.
status?
It's
We hear
really,
this all the time.
we hear it all the time. I think it's interesting that we hear it with a bit of gusto and urgency behind it. And, again, not to minimize the risk, but just say, what do we do about it? And, the biggest one is to say, okay, what are we actually talking about? We're talking about, whole oil industry potentially going off the US dollar. We're talking about China no longer using a US dollar. We talk about Europe no longer trading internationally with US dollars. And we talk some of the statistics of what's actually happening. But the biggest one we talk about when we talk about currency risk is I guess I'd say the speed at which currencies change. They
Mhm.
can overnight things move in bits, but to really pull the dollar out of the international community, for people to go off the dollar, it's this 800-pound gorilla in the room of how many countries use this. And I think there's a statistic we were looking up that of all the different international transactions that use a dollar on one side or the other, I want to say it was 80% of
Yeah,
all
it's
transactions
it's very high. It's very high.
still use a dollar. And so, there is a risk that people go off the dollar and our currency isn't used as much. But we see that as a risk that's not an overnight, it's just going to happen, but it's going to start cracking and cracking meaningfully. And it's going to be very difficult for the world to get off of the dollar.
Yeah, and it's natural that the dollar will lose some of its dominance as economies spread and get better. I mean, I would love to see the economy, democracy spread across the globe and people lift up their lifestyle and standard of living. And will that have effect on the dollar? Sure. But more importantly, it's you're living in an environment that is better for you. And we get these repressive regimes, and they think they're going to control their currency and then have control over the dollar. And it doesn't work. I'm sorry.
Mm,
We've got data. We can go back and look at the dollar has become more dominant in the last 10 years, not less dominant. And it's
mm,
because these governments are more repressive. They hammer that like I don't want to go down the individual governments, but it just doesn't make any sense. And all the data that we look at, I always ask this question to somebody. I said, would you rather have a dollar or a yuan? Would you rather have a
mm.
dollar or a yen? Would you rather have a dollar? And the bottom line is, no, I want the dollar. I said, well, you think if it's going down, why are you concerned about it? So anyway, there's again, that's that going back to that initial comment that I made. Emotions get ahead of your logic. And so people see things, they hear things, and their emotions get ahead of them. And
Mhm.
that's what drives their decisions, which we try to bridle that back and say, don't make those choices. And life is more than a one-day deal, right?
Yep, that's right. So I think as it's a good comment as we see all these risks, that are out there, and you want to be, sober minded that there's real risks. But
Mm-hmm.
the questions we want to walk people through emotionally is, is this risk actually going to impact you? Is this really going to be a problem for you that we need to adjust for, or that you need to adjust for? Second, what reasonable adjustments besides just in and out, yes, no, but what reasonable adjustments can be made to really account for that risk and cover over it? Um, and then the biggest piece of this is letting investments and letting those work over time. They just need time in the market. And so, to pull out or to put in is very difficult to have
Well,
that work as a functional strategy.
and we've become an environment of gambling, and we now
Mm,
have their prediction market now. And I think it's the ultimate gambling. I don't know, whatever it is, it's the tag. I hate it because
mm,
investing is not gambling. It's not going to Las Vegas and trying to pick the right numbers. That's why I hate gambling. Investing is doing your research, investing in a company that you believe is going to provide a good outcome. That's investing. That's not everyone wants a short, I invest $10 and I get 20 back. I mean, well, you invest 20 and you get nothing back. I mean, it just
yeah.
moves very quickly from that standpoint. So I believe the market has this, to some degrees, there's enough people that have this gambling mentality
Mm,
that I think it's, for a lot of people, it's going to be the ruination of them. They're
yeah.
going to end up with zero at the end.
Yeah, it's getting away from this get rich quick or even protect quick, but rather let's move forward slowly, methodically, and purposely. So, if
Yeah.
we missed any of these risks, we'd love for you to share what you're concerned about. We'd love to address those in a future episode. We thank you guys for listening.
Until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordatvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordatvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.